Hello and welcome to Live Squawks Market Talk Preview on Thursday, the 23rd of July, 2026. We're recording this in the morning ahead of the ECB interest rate announcement later in the day. For those we listened to this before the announcement, we've got that due at 12:15 GMT, 14:15 Central European time, and then half an hour later we'll have the press conference thereafter. We'll have a look at all that shortly. But just a quick disclaimer before bringing my two guests. My two guests today are both very esteemed ex-bankers, really, both of Swiss origin as well. So we'll get a neutral but a very sort of refined take on everything at the moment. So I'm joined today by Beat Nussbaumer, founder and CEO of Macro Beat. He's an FX macro trader, researcher, and FX tutor. And by Günther Grimm, strategist and trader, 25 plus years in the FX fixed income, macro and quant markets, and owner of GGMA, a platform for traders that you can find as an app and use on your phone. Before we start talking to our two guests, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investment and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Good morning to you both.
Hi, good morning, Harry, and thank you for having me. Looking forward to our discussion.
Hi, Harry.
Hey, Günther.
Thanks again.
Right. Always a pleasure. Just before we get into it, just a quick preview here. We've got a preview on the LiveSquawk website, livesquawk.com. You can go there. It's open to public, and it's really just covers what we're expecting from today's decision. But more importantly, and we'll get into this, what we're likely to see down the line from the ECB. I think everyone can agree that today's decision is expected to be pretty much a non-event in the sense that rates are expected to be maintained at current levels. So that being the deposit facility at 2.25%, the main refinancing rate at 2.4%, and the marginal lending facility at 2.65%. The recent resurgence in Middle East tensions has thrust inflation back into the spotlight, reinforcing the possibility that the European Central Bank may need to tighten policy further after its quarter-point increase in June. That was, I think, the first increase since August of 2023. And the first movement in rates for about a year. Morgan Stanley in a note said the recent bout of oil price volatility served as a reminder of the uncertainty surrounding the energy outlook. This alone should steer the ECB away from leaning strongly in any direction in either the statement or the press conference, as economist Jens Eisenschmidt wrote in a research note. Following its June rate increase, then the ECB said the conflict in the Middle East was generating inflationary pressures, and that decision to tighten policy was robust across a range of scenarios for how the shock could evolve and affect the euro area's medium-term outlook. Policymakers also warned that the outlook remained uncertain, with upside risk to inflation and downside risk to economic growth. Right, we'll start with the analytical side first, I guess, and then we'll come to the trading point of view. So, Günther, from your perspective, what are your initial expectations from today's meeting?
Yeah, of course they hold, but then what is more important is the outlook, the language, the statement, the headlines. And I guess given where oil prices are trading, i.e. rising again, they're a bit in a difficult position. And therefore, I think they should lean towards another hike, given that their only mandate or the main mandate is inflation. And they are already above target, and their forecasts are still above target, assuming even rate hikes. So I think they would be well advised to convey a bit of a hawkish message. Don't pre-commit, because oil prices can also drop tomorrow again. Given the way it's trading, because are driven by Trump's comments and the conflict in the Middle East. But as things stand, they should convey a bit of a hawkish message and be committed to to their inflation target and try to get it under control and therefore hike a bit. Harry?
I've got to learn to take myself off microphone. What I was saying was that we've discussed before, I think, that potentially the June hike was a policy mistake and that they might have to row back on it at a later point. Obviously, they can only deal with the situation at the time. And at the time, you know, they were worried about the inflationary effects that had already happened, that was already embedded within the system. Soon after their new decision, we had this agreement, this MOU, ceasefire MOU, and discussions about a more long-lasting peace between the US and Iran. Obviously, since then, I think it was the 8th of July, President Trump came out and blew that out of the water by saying the MOU is now dead in the water, and they would resume fighting Iran, which they have done every single day since that announcement. So ultimately, they're dealt a really hard hand here because they're trying to navigate with the background of a very volatile situation in the Middle East. I don't know, where do we go from here? I mean, where do they go from here? I mean, is September going to be enough now? Is it still over egging the pie? Yeah, what do you make of this as a trader? How do you navigate this, and what are your views on not only today but potentially what we'd like to see down the road?
Yeah. To be honest, I had a look. I just checked it this morning, so it may be 2-3 hours old. But we had like 23 basis points price for September, 47 basis points price for December. So call it 2 hikes for the rest of the year. As you just pointed out, just after the June hike, we had this sort of sharp drop in energy prices post the MOU, and it looked like a policy error. Now suddenly we kind of back to square one. So maybe it's not a policy error. I think the key issue has always been, and I've always been a big critic of that over the years, that the correlation between ECB policy and the oil price is just a little bit of a joke, but it comes down to the single mandate, which is obviously not their fault. That's just what their job is. And so we have to look at that side of the equation. To be honest, there's a difference between the FX market and the rates market. The rates market is maybe a little bit, it's flip-floppy, but a bit more transparent in a way that, okay, oil price goes back up, so yields go back up, blah, 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 inflation risks are back. On the FX market, that does just translate into one big mess because everyone has the same sort of issue. So the euro is trading more or less in a very tight range most of July. And whenever the dollar tries to weaken, we get some, missiles flying about or vice versa. So we're just going nowhere on the FX side. The second thing, which is always the problem, is at what point is that the FX market deciding whether the rate cap is bullish or bearish? And we might have had a little bit of a micro short covering overnight and early this morning in euro and euro cross. It's just kind of, the just in case kind of scenario. But I don't think anyone thinks much more beyond, because, if oil price makes the ECB hike another 2 times the rest of the year, how bullish really is that for the euro given the impact on the economy? So the FX market is really locked into this kind of geopolitics on the one hand, trying to sort of sort out this exceptionalism in the US, the sort of dollar move that we saw in the last maybe 1 or 2 months. Is that still going to last, not going to last? So there's I haven't seen such a messy FX market in regards to trying to fit in the macro side, which is kind of all going the same direction of either higher rates, lower rates, and then obviously mix in what you just alluded to, the sort of volatile situation on and the Gulf. The one thing I would like to say about the events in the Middle East, I think the market is still just betting on taco, and hence we seem to be mispricing the risk. I think this story has moved on a little bit further and is at risk of getting out of control somehow. I mean, we have the Houthis involved now in the last few days. It seems Trump is going to have a go at this Pickaxe Mountain, which is going to be a heck of a campaign because there's a lot of bombing to do if you want to get down to 100 meters, which their bunker buses only go to about 60 meters. That means they have to bomb Pickaxe Mountain about for 2 weeks and drop the bombs into the same crater every single time. So I'm not sure. It just seems, also listening to experts, we're moving further away from a talks or whatever. I think an MOU will not cut it anymore, so it has to be something much broader, and there's just little hope of anything of that to happen. So I'm still astonished on how relaxed the market is about the broader risks of this thing really, as well in a sense of the oil price getting totally out of control. So this other leg on the Red Sea is something to be watched very carefully. And for once, I'm not sure. Well, Trump may tackle eventually, but I think the market is wrong about the timing of when Trump is going to tackle. I think it's going to get a lot worse before maybe they go back to talks. But that's just a sort of going back to macro monetary policy. That is the problem from the ECB, the oil price. And so, you know, they probably know as much as we do where this is all going. That's actually the truth of it. And I'm just not too optimistic in the short term that we solve that issue in the Gulf anytime soon. So September is definitely a given. I think 2 hikes. Do we look past 2 hikes? Because 2 hikes is more or less priced. I think not at this very moment. So hence, effects-wise, I can't really see this to be the biggest of all story. Maybe, you know, micro, you know, 2-3 hours of fun or a day or two, maybe a little bit of, but I can't see us break out of any of the current ranges on the effects side from today's ECB meeting, no matter what the outlook is. Maybe we can get a bit of buy the rumor, sell the fact, in the sense that, yes, we have more or less priced 2 hikes. Is what we hear today not pointing to more than 2 hikes, and we can see a little bit of give back on the euro side. But, you know, this is all like on the margin. I don't think there's any risk of any breakout up or downside on anything euro.
Yeah, I mean, we're not going to get new staff projections today. We just had them. The next set is in September. So it would lend to the idea that if we are going to get a move, September will be a more sensible time to do that. Deutsche Bank, note here, calls the whole thing a hike, pause, hike. A second, and in their view, final 25 basis point hike to 2.5% in September. So that's Deutsche Bank. So there is, again, that expectation is fairly well built in. If we look at the language then that we're going to hear, because it's, you know, the decision itself, maybe the statement will give us something, but that's not expected to illuminate too much. So Gunther, from the language and wording, do you expect anything from Lagarde today that would either shut the, well, I don't think he's going to shut the door on September for sure, but give us any hint that September is in their minds?
Yeah, I think they should also be a bit worried about the oil price, what we just discussed, and that it's rising. And not just oil, it's also gas prices. They're also on the rise. So that feeds into inflation. Of course, it will hurt growth. So we are heading back maybe towards a stagflationary scenario. But given the mandate, I think they should emphasize the inflation mandate, and therefore should sound a bit hawkish. I say should because that might not happen, because I think inherently the ECB is a dovish institution, but that's a long discussion. And I think there are lots of policymakers on the board who don't want to hike because they're afraid of higher interest rates choking growth. But if they're behind the curve, the long end of the bond market might not take it well, i.e. you could see a steepening. And that is also detrimental to European finances. So I'm a bit more old-fashioned, conservative central banker. And I think you want to nip it in the bud, just do a hike. I mean, still we are talking about real rates which are close to zero. So let's assume they hike to 2.5, you have inflation around 2.5, your real interest rate is 0. And that's clearly not restrictive. It's maybe neutral. But if you think real growth should be in the Eurozone maybe around 1%, in theory, your real rate should be around 1% as well. So again, it's hardly restrictive. And
yeah, true. And we have to be mindful that energy isn't the only source of inflation or the only element of inflation that they have to worry about. The ECB's wage tracker, this is at the June meeting, and surveys on wage expectations continue to indicate that wage growth should ease over the year, according to the last statement from ECB. However, it is becoming more expensive for firms to source their inputs, and they therefore expect to put up their selling prices. So we're looking at maybe slightly more embedded inflationary pressures on the domestic front as well, obviously framed by what we're seeing, internationally. But there seems to be a worry, a growing worry. This is becoming an ingrained inflationary pressures. Gunther, does that reflect in what you see?
Yeah. Yes, correct. So as a central banker, you want to be on high alert that there are no second round effects, and you want to be early and maybe even preemptive, just to, as I said, nip it in the bud. I look at German break-even inflation rates over the 10-year horizon. They're just above 2%, which is fine. If they were to rise after the ECB meeting, that would be, for example, a bit of a negative signal that maybe then the ECB is falling behind the curve. So they will watch that as well and steer policy that way. Also, one quick thing on FX, because Beat mentioned it. I noticed that Euro Swiss and also Sterling Swiss is coming back to life. Sterling Swiss is really surprising me because I'm a bit skeptical of what's going on in the UK, and Beat probably can tell us more about it, and you, Harry, of course. But I think it's a bit more negative what's going on there, i.e. more spending, don't know how to finance it, and that story. So should reflect negatively on sterling, but it's not. And Euro Swiss also is creeping higher. And I wonder if now the yield differentials will play more of a role guiding these currencies, these pairs higher, i.e. to be long Swiss, it will cost you every day a bit, and maybe even more so if the rate differentials widen from here. So I think that's worth keeping in mind.
I could add something on the Swiss franc there, Günther. This is just sort of, some stuff that is happening in FX right now is more to do with default moments than actually true macro. So what we've seen in Euro Swiss in the last few weeks is whenever dollar yen taken out the next level on the upside, we see dollar Swiss and Euro Swiss creep higher, as what we do see is those that are very short the yen are just hedging some of that MOF risk by selling Swiss yen. So what you suddenly get is this kind of hedge idea of people that are quite short the yen, rather than keep on covering that side only. They sort of shift the funding currency from yen to Swiss whenever you fear that the MOF would suddenly show up. So it's a kind of very simple hedge trade where all you actually do is you still are in a funding currency, but it just changed. I mean, Swiss yen is about 60% overvalued anyway. So what you see is whenever dollar yen creeps high, takes out the next hurdle, you see Euro Swiss following and keeps Swiss yen is probably the only yen cross right now that is actually a little bit under pressure versus the yen being weak against everything else. Sterling Swiss, to be honest, what we've seen this year a lot is the same as with cross yen, which is more of a dollar trade right now because you have a manipulated dollar yen. So dollar yen creeps up slowly when the dollar rallies, so cross yen is going down by default. So we have a lot of default moves in FX right now that have to do with either worries or true, I call it manipulations, maybe a bit of a strong word, but let's say there was definitely some FX management going on in dollar yen on an unofficial kind of way in dollar yen. That's why it sort of creeped up so slowly, while the rest of the dollar complex rallied a bit fast. That obviously has its impact in the crosses. Sterling, Harry knows my view, don't get me going. I think that is just, again, a pace issue right now, rather than, I think, the overall, I can't see Sterling Swiss putting in a big performance. I don't think the Swiss is ready to have a big move. We're just hitting these upper levels in Euro Swiss, 93, 93 and a half. I think we remain in this range. I think the market is just not willing to sort of put the carry trade into the Swiss franc back into place. I think the natural move, as you know yourself, Günther, is the current account just keeps, if you don't have anyone trading Euro Swiss always going down because of the current account. So I can't see a trade there, but at some point maybe rate differential does matter. And I mean, we had the situation most of this year already, and it didn't matter until most recently. So I can't totally say it won't matter at some point, but if you just look at the moves of the last 2-3 weeks, it has a lot to do with other markets rather than the market itself. So keep an eye on the Swiss yen. That's the sort of big potential story out there if anything happens on the Japan side.
Well, we would certainly. I know we were talking pre-start about the yen. There's an interesting report from the Nikkei here that says that though many US institutional investors think the yen is undervalued, they remain reluctant to buy the currency as they await clear policy action from the Japanese officials. Again, the yen had depreciated to 163 range against the dollar on Wednesday, a 39-year low, and the currency has hovered in the 161 to mid 162 range since July 6th. For the last 2 weeks, the yen has exhibited calm compared with its wild fluctuations over previous months. This yen story is, I think it's, if we're looking at something to, I know this is the ECB preview, and we'll come back to the ECB in a second, because it's all interlinked in a sense. What have you made of this yen story? I know you've been talking about it a little bit, Günther. What have you made of this yen and the weakness, and how would you play that if you were still behind a bank desk talking and discussing it with some of those big clients with loads of money?
Oh, well, they wouldn't talk to me anymore, because I would have told them the yen story a year ago, to be fair.
Right.
So it's very frustrating. As I said, the policymakers are behind the curve, and unless you see a big sea change there, i.e. BOJ coming out, maybe hiking next time and sounding more hawkish, backed up by policymakers, backed up with intervention and then repatriation flows, that would be a major event. Is it likely? Probably not. So they will continue to manage the currency, hoping that it won't explode to the upside, dollar yen, I mean. And as Beat also said, the Prime Minister is probably quite happy with the weak yen. She's on a reflationary path, but they're risking a blow up in the JGB market. And maybe we need that really a sharp rise in long-end yields in Japan to wake them up so that they have to change something.
Well, we did kind of get that hawkish message out yesterday, didn't we? That they were willing to go quicker than the current pace of every 6 months to every 4 months, every quarter, which didn't really animate the market that much at all. But in terms of your views of trading it at the moment, as a currency trader, how hard or easy is that for you at the moment?
Well, very hard. But I think it just needed, the problem we always have is whenever you had a big round of intervention, which we had some while ago, it's always sits in people's minds. So there's always a risk that the markets is selling rallies in dollar yen because they expect the MOF to come back. And so that creates this sort of uneven positioning in the short term. I think, what I changed is I kind of, even though it's not easy at times just to forget dollar yen, just to realize as long as oil is going up, as long as bombs are falling, as long as, the broad dollar is big, don't expect the MOF to come back because, they already spent $70 billion this year. They can't spend another 30 and be wrong again. So I think they would only come back if the dollar were to weaken for some reason. So use the momentum of the dollar to intervene if they plan to do so. So that means what? You have to, so I shifted my focus to cross yen. So cross yen, selling key levels in the rallies in cross yen has always been like an indirect dollar long. So rather than selling euro dollar, you sold the rally in euro yen, and that's how you could make a living even with a broader weak yen. And whenever you sold euro yen, you benefited obviously from a euro dollar dip. You then always had the chance. It's almost like a sort of two options. One option is your dollar goes down and you make some money in your yen, which you can wonder why don't you sell your dollar in the first place, which is a fair point. But you always have option two, and option two would be some surprise on the yen side, which obviously hasn't happened up to this point. But I want to bring something else in. I think what we heard from Mrs. Katayama, I think last week when she started to talk about upping the investment percentage from GPIF in JGBs, create a product for retail so that these NISA flows, the NISA flow is the outflows of retail Japan. 90% of Japanese money is going still abroad, buying foreign bonds, buying foreign equities. So they try to create a product that would also then make a share, a certain percentage share of the domestic market or the retail market also buying JGBs. So that would reduce some of the outflows. That's obviously not a quick fix, but some of the architecture of what I heard last week reminded me of this maybe being discussed with the US Treasury, with Bessent in particular. I think Bessent still has this one big issue, and we may remember this early this year, and the Fed was checking rates on behalf of the US Treasury, which it turned out so it wasn't actually the Japanese that asked for it, it was actually the Treasury, US Treasury that asked for it. Bessent is paranoid about this JGB market. Last time the JGBs started to create this broad sell-off in the bond market. Now obviously we have oil and the war as well that's going the same direction. So I think there's something where the US Treasury Bessent is keeping an eye on the situation and trying to help the Japanese. And I think they actually made the Japanese understand this is no longer about managing dollar yen or managing single elements of this. This is all one big cluster of the story. Credibility maybe on the fiscal side, changing the underlying flows from domestic Japan into JGB, whatever it is. It just sounded, when I read that story last week, it sounded, you know what, this could be directly from Bessent. And this is something I truly, truly believe, because the Japanese themselves, they would make a real mess out of it for the reason what Günther said earlier. They come out of this sort of shock from the plaza in 1985, gone on to the deflation story for decades. So they're so scared on hiking too quick or messing it all up and this and that they will always be behind the curve if not something were to happen. And maybe it needs something a bit more unorthodox, like the current US administration, which just at some point say to the Japanese, this is what you got to do, just do it. Right, and so I wonder. I couldn't put a rate on it and say, 165 or $170 yet, but I think there's something in the making out there, which we don't yet see. But I think the pieces will fall in place. There is a massive story in the end. We talked about it last year. I would have been also so wrong if I wouldn't have sort of, managed stuff in between, because I thought this yen story comes a little earlier. But I still think, it will come. And maybe I was a bit too early in the sense that, something that worked for 30 years for the Japanese and now stopped working or changing. Maybe I was expecting too much for things to change that rapidly. Maybe the change is also going to be slower than expected, where foreign investment will start to be kind of reduced in favor of domestic investment. This whole yen carry game is going to change. But in the short time, and the last thing I want to say to this is, and this is something I confronted daily or weekly, that I can see that the market is functioning a lot more through algorithms rather than humans. So that means certain stories need a little bit longer to develop because we don't have these sort of market reaction like 10, 15 years ago when traders just hit the market because of some story they see somewhere. Now it's like alders and, there's no sellers. So, okay, so it's going up until we get sellers. And so the market behavior has changed a little bit as well. And so that's why maybe we have the situations like I meant earlier to say about the sort of personally, the sort of wrong price on the risk from the Middle East or things like that. It's almost like, I tend to say, and then I give the ball back, it doesn't matter until it does. And I think we are in that situation where it gets ignored, and then there be something that breaks the straw that breaks the camel's back, and everything changes, and everyone is going to look back and go, oh yeah, that will really really important back then. Yeah, I think we are in that period, but timing-wise, I'm not going to lie, it's very tough.
Yeah, fair enough.
Also,
Listen, I wanted to, by the way, just because we're coming to the end of the episode, Bank of Japan is next week, so 30th, 31st, we'll get the policy announcement from Bank of Japan. Gunther, so you were going to say something?
yeah, just quickly, we shouldn't forget that Bessent, I mean, he must be incredibly frustrated with Japanese policymakers, and he's incredibly patient at the same time. But so, yeah, I agree with Beat. Something is in the making, but one needs to be super patient. Also, on that note, because all these, I mean, Japan, and you can also throw probably China into that spot, they're really pursuing like a beggar your neighbor policy, i.e. trying to keep their currency weak to benefit via higher trade surpluses, higher exports. And that, of course, hurts growth in these other countries. It's not really a zero-sum game, but it affects negatively the other countries which have a deficit. On that note, you might have seen the discussion between Macron and Merz, the German chancellor, complaining about the huge trade surplus the Chinese have vis-a-vis Europe. So that goes into a similar direction. So they're complaining indirectly about the currency. Will the ECB take note of that? They always say, no, we are not involved in steering currencies. We look at it, but we don't manage them. But so maybe that could be another argument not to be too hawkish, so that the euro doesn't get too strong vis-a-vis the Japan and the Chinese.
It's all starting to sound a little bit like Trumpian policy, doesn't it?
It goes into that direction, yeah. Deglobalization, and
Yeah.
I'm surprised that stock markets don't take note from a long-term perspective. It should be negative for growth,
Yeah.
positive.
On that note, then let's bring it back then, just to give you the sort of highlights of what we're looking for. Then, so the decision comes Thursday afternoon, and it's going to be at 12:15 GMT, 14:15 CET, with press conference 30 minutes later. Expected to keep rates on hold, all main rates, deposit facility at 2.25%. But it's really more about the messaging and what we're likely to see moving forward and the expectations for a September move. Gunther's kindly put together just a package here of different bank expectations. You've got JP Morgan, if you look at the screen, JP Morgan September, and then another 25 basis points. So they see circa around 2.75% rates. The media know it is one and done after September. Really, Daiwa were there looking for September 25 basis points. Nomura also, Citi hike by year ends. They've broadened that a little bit. Goldman Sachs, they see a hold in September, just being a live event for the timing as well. But that chart's up there for you to look at. Right, we're going to close out the episode now. I'd like to thank my two guests, Gunther Grimm of GGMA. Thank you, Gunther.
Thank you very much. Thanks for having me.
And Beat Nussbaumer. Beat, thank you very much for your attendance there as well.
Thanks, Harry, for having me.
Yeah, you can find it at Macro Beat. We'll send out all the links for those that want to connect with our two guests today. Anyone who's missed the start of this, go back to the on your social media platforms and on X, and you can find us there. Take a trial out of liveschool.com if you want to listen in live to the rate decision and any comments that come from Lagarde following that will be all over that as well. There's plenty of research on the website as well. But thank you all for listening. Have a great day, and we'll see you again very soon.